Good day, everyone. My name is Rebecca Lilly for the International Association of Energy Economics. It gives me great pleasure to welcome you to today's webinar entitled, Welcome to the Foothills of the Next Multi-Year Boom Price Cycle in Oil. We are grateful to James Smith and Robert McNally for today's timely discussion. First, a little bit about the International Association for Energy Economics. We are the largest association specializing in the field of energy economics and provide a forum for the exchange of ideas, experience, and issues among professionals interested in the field. The organization produces 2 professional journals, a newsletter, and holds conferences and virtual presentations along with a host of other products and services you can find at our website at www.iaee.org. If you're not already a member of the association, we welcome you to join. A few housekeeping matters in regard to today's webinar before I hand things over. First, this webinar is being recorded for those that cannot participate in today's live event. If you have questions for our speaker, please click the Q&A button at the bottom of the Zoom window and type your question. We've allocated time at the end of the webinar to read and answer them. And now, I would like to introduce you to our speaker, Robert McNally. He is founder and president of Rapidan Energy Group, a Washington, D.C.-based independent energy market policy and geopolitical consulting firm. Robert, over to you.
Thank you very much, Rebecca, and great to be with you. And thank you to the IAEE for sponsoring this webinar. And it was great to be with James last month in Riyadh as well for the outstanding conference there with the IAEE and the CAPSARC. Thank you all who decided to join. I feel a little bit like the guy in the movie Airplane who said, I picked the wrong time to talk about a multi-year boom cycle in oil prices, right? I mean, please ignore the dumpster fire out our windows here as crude oil prices are melting down with, contagion risk, higher recession risk, and so forth. So, oh, well, the show must go on. But I'm, for this conversation, I'm hoping we can all get our minds out of what's happening outside the window and the huge risks near term, and think about where the oil market is headed later this decade, in the coming years and into the end of the decade. And in a world in which, unlike the one we see right now, there's confidence in decent economic growth and there are no exogenous macroeconomic, financial, geopolitical shocks hitting the market, i.e., when we think about doing a normal medium to long-term forecast. So if we could just all put ourselves in that frame of mind for the next hour or so, that would help me, I think, and help the message I'm going to deliver. We'll get right into it. I'm going to take about 30 minutes max, and I'm going to run quickly through a bunch of slides to make my points. And then I really look forward, as always, this is an outstanding group, to your questions, comments, points of view, pushback, etc. So I'm going to speak pretty fast, but I think there'll be a recording for those of you who want to see it later. So let's get going. I'm going to start with the bottom line up front, and I'm going to show you this slide twice. But when I think about the next 3 to 10 years in oil markets, I think the consensus formed by the International Energy Agency's forecasts and others like it is on the left-hand side of the chart there in green. The supply growth in the next 10 years, if you look at the prevailing forecasts, and this is everything, OPEC, non-OPEC, due understandably to the collapse in upstream oil and gas investment since 2014, is going to be pretty low. 200,000 barrels a day, maybe 300, 400 noise, but not a lot of net new investment. I think certainly I and most observers would agree to that. Where the big difference comes in is on the demand side, especially for transportation sector use of oil later this decade. And if you look at the prevailing forecasts that form the consensus since about 2020, they are sort of on the roughly 500,000 barrels a day of annual average consumption growth. That is unusually low in a 100 million barrel a day market with the world typically growing around 3%. Again, no big problems like today. normally oil demand grows at about half the rate of global GDP growth. So normally you'd expect closer to 1.5 million, but and we'll talk about this a little more, the prevailing forecasts see about 500,000 barrels a day. Now, if you believe that, then we've got not a loose market, but we've got a pretty balanced market. I mean, noise of difference with a few 100,000 barrels a day, so it may be slightly tight, but pretty much balanced. However, as I'll explain, I see absolutely no evidence whatsoever to justify a view, much less a consensus view, that oil demand growth is going to get crushed this year. This decade. I don't see that, and we'll discuss that in a bit. And I think, therefore, if we live in a world unlike today's, growing healthily, et cetera, we're likely to see closer to 1.5 million barrels a day of demand growth, not consumption perhaps, but demand growth. And since we all agree supply is more or less capped, that to me means we're entering a structurally tight and bullish oil market. So that the oil price must rise to enforce the iron law of economics, which says you cannot consume. You may demand what you demand, but you cannot consume what you cannot produce or reduce from, or remove from inventory. So that's where we're headed. Anyway, let's get going here. How the oil market works. Prices are volatile. Don't need to tell you folks that. But it's also true we haven't seen the amplitude of the price range in the last 20 years and the causes for the huge swings in the last 100 or so. You just don't see a near quintupling of oil prices without a war in the Persian Gulf in modern times. And you don't see collapses in oil prices as we did after 2014 without a recession. Yet we've seen those now. So really, I think you have to ask ourselves, what is causing over the last 20 years a kind of an oil market where we get wild boom-bust price swings without the usual suspects, wars and recessions? And when we investigate that, and what I do is I find you have to look at history, but you have to go before the Arab oil embargo of 1973, where most discussions of history begin. Actually, you have to go back to the beginning in 1859. And when I did that and analyzed this for my book, Crude Volatility, what emerges is that oil, no surprise, is intrinsically prone to wild boom-bust price swings, to levels at the top where they cause recessions and the bottom where they force shut-in of production. And that's because of extremely low price elasticity of supply and demand in the short run, and the fact that storage is neither infinite nor costless. And I don't think I have to explain those concepts to this group. Okay, so you have an extremely boom-bust prone priced commodity. The only thing we've seen in history, the only action that is able to counter and depress this natural wild volatility is a swing producer. Country or companies, group of countries, states that provide what normally do not exist in the oil market: flexible, elastic supply. And we've seen three through history. Rockefeller came in and by monopolizing refining and integrating with transportation, midstream, so pipelines and railroads, was able to be the first, let's call it, didn't get rid of price volatility, but he drastically reduced it. We busted up Rockefeller in 1911, and so from 1911 to 1932 was the last time we saw a prolonged period of wild boom-bust price cycles. And it was no fun because oil became now a critical transportation fuel, graduated from illumination, and now is a critical fuel as it is today for living standards, national security, food, medicine, everything else. So government said, no way we can have this price volatility. So we had the Texas Railroad Commission, by far the most successful swing producer in history, came in and with working with the majors and other oil states, imposed quotas, upstream quotas, not like Rockefeller, went right to the upstream and imposed quotas, well by well, field by field, for 40 years, meeting every month in Austin to impose those quotas. And they gave us stability, the best stability we've seen in the oil market from 32 to 72. And then OPEC took over from the Texas Railroad Commission in 1972. And then when, in my view, the reason we were sort of back on these Space Mountain oil price rises is because OPEC lost control, just as the Texas Railroad Commission did. So here's a shameless plug for my book. I'm very sorry. Just to make the point that, you had Texans. I mean, the lengths people will go to suppress price volatility for oil. Amazing. I mean, the Texans pro-free market, pro-business, anti-government. Having worked for a Texan president, I identify with all that. But wow, they imposed to heavy-handed central planning and government control on oil producers to vanquish oil price stability. As we saw in 2020, even President Trump, arch foe of OPEC, became an OPEC hero award winner by organizing the cuts after prices collapsed in 2020. And there's a picture of troops going into the fields ordered by Texas into the oil fields in Texas in 1932 to literally prod drillers away from their wells to stem oversupply. So point being, the only thing worse than OPEC or Texas Railroad Commission managing the oil market is them not doing that, because you get these wild price cycles. So question might arise, well, Bob, what about OPEC Plus? Don't we have a new swing producer? Isn't Russia and Saudi Arabia and the group of their 22, 23 countries, aren't they effectively the new swing producer? And I think the jury is still out on that, especially when it comes to being a durable swing producer. OPEC Plus has had its successes. It's now having success. It was successful in October in cutting. It was successful in the summer of 2020 in cutting production. But we've also had hiccups and failures and disasters like March of 2020. And it took them a year through 2015 to come together, and oil prices are very weak. So we've seen in other boom bust eras where you get temporary supply management organizations come and they fail because of cheating within and excess production without. We should all hope, by the way, for the success of OPEC Plus in terms of wanting stability. But right now, I think the jury's out. But it's certainly, shale is not a swing producer, and we can talk about that in Q&A if you want. It's flexible supply. It's much more flexible than conventional oil production, but by no means is it swing production of the type that's required to keep oil prices stable. Here's just a final look at the volatility metrics we use. I made a monthly continuous oil price series back to 1859 for the book. I'm happy to provide that, by the way, to anybody who would like. Just email me. I took the min-max for each year and then averaged those across the eras I've identified for the book. And you can see, since the last 20 years or so, we've been in the third boom bust era, no effective, durable swing producer. And so we've got volatility on my metric just about where it was at the last multi-decade period of boom bust prices, 1911 to 1932. Okay, next big surprise, demand. This shows you historical demand, recession bars from the IEA, from its World Energy Outlook. And until 2020, the IEA included in its forecast, as many do, a reference scenario, assuming no future change in policy, so existing policies, where oil demand is headed. But this became very controversial in the environmental community because it was showing oil demand was headed towards 120, 125 million barrels a day. That was exceeding the net zero targets and budgets and so forth. So the IEA decided to cancel, literally obliterate, can no longer consider a business as usual, what they call a current policy scenario. And they adopted as their new quasi-reference case. They don't call it a reference case. It's called STEPS, but it's the scenario everyone looks to as the quasi-reference case. This green bar, which assumes future policies changes in line with stated targets for decarbonization. And as you can see in the chart, assumes that oil demand is going to peak in about 10 years. And the real interesting thing is the reduction in the rate of growth over the next 10 years, right? It's not like it's a cliff and we kind of gradually get into it. And they don't give us any evidence of why they assume this, and they don't provide a lot of data, but they do say that the reason we're going to see a slowing in growth and a peak is transportation sector demand. So it's not petrochemicals, it's not industrial use, space heating, et cetera. It's all about cars and transportation going to electric vehicles or really near-term super fuel efficient cars. So I asked myself, is this justified? Because this is the new consensus. Everyone pretty much has a forecast. Some people see demand even faster, peaking faster than the IEA. Long story short, we can get into it in the Q&A. I've got 15 minutes and I'm going to get through some more stuff. Rapid and my analysis, we see no evidence whatsoever to justify adopting a peak demand as a base case, and much less literally canceling a reference case scenario. The policies are too weak. Consumers are going the other way. And as we see, especially since Ukraine, policymakers are, if anything, starting to decelerate in their enthusiasm to push climate policies. Even the IEA itself, as you see here, warns that SUV demand around the world is growing so fast that it's offsetting the emissions reductions from EVs. A lot of bets are being made on fuel economy in the next few years. If you believe oil demand and transportation is about to collapse, demand growth is about to collapse, you've got to believe cars are becoming more fuel efficient, because we'll talk about EVs are just not growing fast enough from such a small base to really put a huge demand dent into oil. I think Argonne did a study looking at displacement from EVs up to 2021, and it was like 0.5%. So we're really, if you believe in this peak demand stuff, this decade, you really got to believe cars are becoming more fuel efficient. And we see no evidence of that since 2014. This is the United States. The orange bar is the price of gasoline. The black line, orange line, the black line is fuel economy of cars being bought. And then the gray line are paper fuel economy standards from the IEA. And you'll see from 11 to 2014, fuel prices were rising and cars were being, consumers were buying more fuel efficient vehicles. However, when oil prices fell, after 2014, you'll see fuel efficiency flatlined. Scrappage rates are structurally declining. So we see no evidence consumers are getting into more fuel efficient cars. The fleet, hard to measure, but with declining scrappage rates and no improvement in new fleet fuel economy, EPA reported no improvement on their metrics in 2021. I don't see where you get to a super efficiency of ICE vehicles this decade, which you need to put a peak in demand by 2020 in the transportation sector. The paper standards are weak, and we can talk about that. I had a lot of experience in designing those for President Bush. By the way, an EIA, and God bless them and the work they do, and they're terrific. But it wouldn't be the first time that we've prematurely predicted a peak in demand for gasoline in the United States. It's happened two times before. I don't think third time is a charm. I think what's happening is we're extrapolating recent events like big oil price increases, which do lead to more fuel efficient car purchases, and then overstating the impacts of policy. And we've done that before. I think we're doing it again. And when we do, we're going to realize demand's going to be a lot higher. A couple other points looking around the world. Rapidan, my company, looks very closely at how the public reacts to higher energy costs, both protests and then just policy reactions. And again, we do all this data. I'm very quick. Bottom line, when the going gets tough, when there's a big increase in oil taxes or removal of subsidies, or for any reason oil prices lurch higher, and you see protests, more often than not, by far, you see as governments cancel the policy, right? You saw that in France epically in 2018 with the Yellow Vest protests that canceled these small little diesel carbon tax that triggered that. You've seen it in other countries as well, Mexico, Brazil, around the world. I mean, Iran is the only country which, by our count, is sort of resolute in imposing higher costs on its producers. I mean, when it would do energy subsidies in 2019, but it shot a lot of people. So mass repression, perhaps, but countries that are willing to resort to mass repression tend to want to favor lower prices for their consumers. And again, since Ukraine, we've had a stress test and sort of public willingness to impose high energy costs or let their consumers see absorb high energy costs. And what we see from our stress tests of a few dozen governments is that most, including in Europe, some of the most progressive pro-climate change countries and states are the first ones to subsidize oil and gas consumption, remove taxes, increase subsidies, et cetera, and so forth. And so all of this causes me as an analyst to doubt whether there's really political will to impose the necessary costs to kill oil demand growth in transportation this decade, which the consensus has decided to believe is the base case. Now, we're getting back to where I started. Again, we all sort of agree that investment in supply is down. This is from the Aramco presentation, very similar numbers like this, Woodmac and others. So we all agree investment is low, but is it underinvestment? Well, it's not underinvestment unless demand is going to rise sharply, right? If a chart like this, if we looked at a chart like this in 1912 for horse and buggy capacity manufacturing, we wouldn't necessarily say that's underinvestment. That's called an industry getting ready to die. Is the oil industry getting ready to die? I don't think so. I think demand, again, for this deck, for the reasons I just point out, is going to grow a lot stronger than people think. Whether it should or not for climate change reasons is another discussion. So we come back to where we started, friends. On the left is where the consensus is. I urge you to go and look at prevailing forecasts. I think they more or less look like this. We're going to get the AEO shortly. I think the AEO is a little more bullish on demand than IEA. If you believe in this world of peak demand, then we don't have a problem. But it's that 500,000 barrels a day of demand growth. You got to believe in that. Now, if we have a recession, if we have a war, if we have other things, we could have demand obviously go lower. We saw that with COVID. We saw that in 2008. I'm not saying recessions won't kill demand, but it's going to take a recession, I think, to keep a permanent recession, to keep oil demand at 500,000 barrels a day. I believe if the world returns to growth, we're going to be back to 1.5. And then if the world comes to that view and we realize policy is too weak, policy is not going to stop that 1.5, then I think we're all going to realize pretty quickly we are structurally short oil and the price will have to increase. Final slide, spare capacity. Again, from my book, we developed a historic time series for spare capacity. So this is producible upstream oil capacity that's held by a supply manager until 1972. That was mainly in the U.S., but also the Seven Sisters were holding a good deal in the Arabian Gulf. After 1972, it was OPEC. Okay. By the way, historical matter, since I have a few minutes, look at the 1950s. The 1950s. Just imagine that for a second. 1/3 of the world's oil production capacity was being held off the market. About 20% in the U.S., mainly Texas, 15% by the majors in the Persian Gulf. What business, what commodity, what activity are we aware of, especially one as important as oil, where supply managers shut down 1/3 of production capacity to keep oil prices stable? If I put a price chart up here, the 1950s were glacially smooth. Again, the lengths folks will go to keep oil prices stable. Something very important for, I think, where we're going and where we're headed. But I want to make a point about the future. So we're going to be updating our long-term forecast. So these numbers are a little bit loose, but they notionally make the point, hopefully. If you look at where we are, of course, we're much lower than we were in the 1950s. If you believe that supply and demand for oil are roughly in balance, and then with the capacity additions that are coming, especially in Saudi Arabia, UAE, maybe some Iraq and so forth, I think the IEA kind of approach to the world, and they don't forecast this, so this is our extrapolation based on their data. So it's, I don't want to say this is exactly their number, but they basically see, if not a super comfortable cushion of spare capacity, a rising cushion of spare capacity up toward about 5% later this decade. Again, wars, recessions, COVID, those kind of things hit the oil market, we're going to have problems. But otherwise, if you believe in peak demand, imminent peak demand, then the oil market is probably reasonably well balanced. We have enough to make sure that if we have a tight market, OPEC can increase, OPEC plus, and if we have a war or a disruption, there'll be some available supply to offset that. If, however, like me, you are quite skeptical of these fashionable peak demand forecasts, and yet you realize oil supply, investment supply has declined, you're sort of on that black line with us. You see spare capacity evaporating this decade, and with it, price stability, and that's structural. So I'm actually 6 minutes earlier than I intended to be for running through these slides. Sorry for speaking very quickly, but I'm glad we're going to have more time for questions and answers, and also your comments and views. Again, huge respect for this group, for the IAEE, and thanks to each of you for joining this morning. So with that, I'll turn off the slides, bring them back up if we have to address a point, and Rebecca, back over to you. Thank you.
Hey there, you do have a question that's pending. We're asking that saying that they can't help but ask your thoughts on the new low in crude at $68 now.
Yeah. Well, so I think, and I know from our clients, thoughts are turning to what is the risk that, as in 2008, we are on the precipice of systemic financial contagion at the worst, and then higher risk of recession, perhaps at best. And what does that mean for this price drop and so forth? And really it gets to, where is the floor? Is there a floor? Is anyone there putting in a floor? Now, I am not a macro financial expert, okay? So I'm not going to pretend to have a well-informed view about where things are going in our banking system or even the macro economy. We tend to just use what the IMF and others and kind of consensus forecasters are saying about the macro economy. However, we all can recognize that downside risk is increasing. So in my view, the market will, if this continues, and if we say is 68 the floor, we'll look to two sources of a possible floor. One, and the less important one, would be the Department of Energy and refilling the SPR. As you may know, the Biden administration, again, to its credit, has signaled it wishes to start refilling at least partially this massive drawdown we had that's lowered the Strategic Petroleum Reserve to its lowest in 40 years. And they've identified a range, a price range of $68 to $72 a barrel, where they would consider and they would look to refilling and say, look, we refilled and we did it at a lower price. And so we are now entering that range. We're in that range. I think the Biden folks want to wait and see a little bit, and I don't think they're gonna act imminently. And you know, there are other considerations with regard to how quickly the DOE SPR could take in the crude. There's scheduled workovers and so forth. But if we grind around here in the 60s for a few weeks, do I see the DOE signaling it intends to purchase more oil? Yeah, I think so. But a 10 or 20 million barrel purchase in the global oil market, to me, it may be interesting and affect trading for a few days, but it doesn't move the needle in a world in which we're considering 2008 type of risks. I think what the Fed is doing and sort of macro and sentiment is much more important than with the SPR. But I think traders will be saying, oh, is the DOE there? Much more important is OPEC plus. Again, the fear would be that as in 2008, you know, things collapsed financially even faster than the registered in the oil data, and OPEC was sort of late to put in cuts later that year. Or you have 2020, where they, in the face of a exogenous shock, they're unable to agree to reduce production. And in 2020, they actually increased production, pouring gasoline on the fire, if you will. I don't think there's a high risk of that. There's another risk is 2014, where the market needs them to cut in November 2014, and they're unable to agree to do so, and prices collapse. So I think Saudi oil minister Prince Abdulaziz bin Salman gave an interview yesterday. Urge you to read it. It's with Energy Intelligence. If you Google his name and Energy Intelligence, you'll see it. He was asked about whether OPEC Plus would increase production, and he said no. He said heck no. Not. He said we will not increase through the rest of the year. He has not ruled out a cut in production, an OPEC Plus cut. But I think I know he is not hitting the panic button. I mean, I don't think I would sort of. I don't think the folks in OPEC Plus leadership are hitting the panic button and considering cuts right now. Just the opposite. I think they're inclined to just lay low and see how things shake out. There is a meeting coming up on June 3rd. If we saw, I think oil prices would have to drop a lot further. And we need to see a further deterioration in oil supply demand fundamentals before OPEC Plus acted. I think it's possible, but I think we're a ways away from there. So to answer your question, at $68 on my balancing of the oil market, I'm looking for opportunities to buy. If you believe my view, I mean, you're looking for opportunities to get long for a structural ride this decade, and I am. But 68 may not be the bottom here until we cease the macro and financial beatings that the oil market is experiencing. Hope that helps.
I don't see any further questions. Do you have any closing comments? Oh wait,
no,
there is somebody with their hand raised. Let me see who that is. It's our good friend Mark Finley. One moment. Mark, you can go ahead and unmute.
Thank you. Can you hear me okay, Bob?
Sure can, Mark. Hi, good morning. Good to see you last night.
Always a pleasure. Thanks for the presentation. My question is on your supply prospects. I mean, is the constraint? It sounds like from the tone of your argument that the constraint is it political? Is it the financial sector? Is it a lack of hydrocarbons in the ground? And what would it take to turn the situation around in your mind?
Thank you, Mark. Thank you, Mark, for that question. And you're very humble, because your thought, I would actually be very interested in your thoughts on that. Very thoughtful observer on it. So I would say the main inhibitor in investing in new supply, sufficient new supply, is to use the military term, sort of PTSD. I think we've forgotten how demoralizing a bust phase is for investors, whether it's the companies putting the rigs to work or the investors financing those companies. So for me, 80% of the reason why we have seen a collapse in investment and we will not see a rapid increase in investment is the memories of the price collapses from 2015 to 2020 don't fade. And we know about this. We hear the investors talk about it. They're still asking companies to return cash, not to drill. This experience of oversupply in the absence of an effective supply swing producer is devastating and doesn't go away soon. Now, that helps sow the seeds of the next boom cycle, right? So you ask, what could cause that to change? I think sustained increases in oil prices, especially long-term, whether it's consensus or futures prices are pretty thin out there, but long-term views on oil prices. When we get into year 2, year 3, year 4, and folks see we've put the bust phase behind us, then I think you will see investors come back. But you need to see that bust phase, 2014 to 2021 or 2020, well in the rearview mirror. But that would be bad enough. And then the challenge is, as you know, given leads and lags, especially with conventional oil production, you don't get the supply online before oil prices have risen so far that they've triggered a bust. And that's the big tragedy of why, and this explains why throughout history, producers have gotten together and tamed these boom bust price cycles, because they're impossible to work with. Now, 20%, Mark, in my view, of the reason why you're going to see a slow investment. We have the resources. I know the costs are going up. The costs are going up. We have the resources. We have the kit. We could be investing. We could. But the reason we'll be slow to do so, 20% in my view, is more what I call above ground risk. And that is, again, the prevailing forecast, the consensus is that oil is about to die as an industry. It's about to stop growing, plateau, and decline. And some others think actually a sharper decline. If you believe that, why in God's name, after 7 years of a bust, would you invest in more long-lived oil investment? You wouldn't. And we're seeing policies being put in place to raise the cost of capital for industry and raise regulatory risk for industry. Now, in my view, since about late 2021, policy to decarbonization intensity, so the second derivative, like the speed of the growth, started to slow. We're still going to decarbonize. We're still concerned about climate change. But with the oil price increases of late 2021, President Biden is starting to talk about we need more shale, starting to use the SPR. And now, as we see with the Willow decision, greenlighting an upstream greenfield conventional project, the no-no project, according to the IAEA, we should not be doing if we want to get to net zero. President Biden just approved. So we're starting to see tiptoeing, I think, back toward a more pragmatic policy. And as I mentioned in our research, Europe across the board has been subsidizing energy consumption, oil consumption specifically, in transportation since last year. And so while they may have plans to ban cars in 15 years or 5 years or 10 years, the policies they're putting in place right now are going the other way. But if you believe that oil demand is about to peak and policymakers are going to put you out of business and raise your cost of capital, and you've just come out of a 7-year bust phase, and all your public investors are telling you return cash, why in God's name would you invest? So that's a added factor, in my view, that's going to constrain the net supply additions. Of course, you're very well aware of declines in existing fields and shale oil especially. So there's those factors which go into a more or less steady, a plateau and capped. But Mark, I'm going to call you out here, if you don't mind, if you can get back in. What are your views on this? I would be, please push back, but I welcome your thoughts. Unless he's already left. Yeah.
Oh gosh, well, that sounds like a good description to me. I would, there's certainly, it doesn't appear to me that the hydrocarbons in the ground, is a constraining factor. So then it comes down to policy and investment.
Right.
And I think policy, of course, varies around the world. But it is certainly an article of faith in much of the oil company community, that policymakers, certainly in the West, have been aligned against them.
Right.
Of course, the conference in Houston last week, showcased the Secretary of Energy and other U.S. officials, extolling the need for more investment and for more supply. But I don't think that it's still there's still a tension there that I think there should be opportunities for both industry and policymakers to engage each other constructively, and including the financial community, by the way, to make the case for more investment, in a way that is consistent with transitional aspirations.
Right.
And that's not necessarily in conflict.
Right. Thank you. Amen. Thank you very much.
You now have a pile of questions, as well as some other people that would like to speak. Let me first give the floor to Robert Kleinberg.
Yeah, good day, Bob. That was really outstanding. You can hear me?
Yes. Thank you, Robert. Thank you very much. Thank you. Yes.
Yeah. Just wonder what comments you might have on how animosity between Russia and Europe might affect trade flows of oil or gas, if you wish to comment on that in the coming years. Is it going to have a big effect or really something that we can overlook?
No, it has had a big effect. And the question I think we have to, Europe is no longer really importing Russian oil and much Russian gas. And I would think they're even heading eventually, looks like, to not even taking in Russian LNG. Pipeline gas is going down. Oil imports have all but, ended. I think we have to ask, and therefore Europe is having to, is import from the Middle East. And we've seen a redirection in trade flows, and the oil market's pretty nimble and flexible in responding to that. I think the question we have to ask ourselves, to your point, is how long is this going to last? And as I see no end of it. I think of 3 scenarios. If you think about how does it end with Russia, right? One would be the happy scenario. Putin is somehow dismissed, and we have a new government in Russia which apologizes for invading Ukraine, withdraws and joins the EU, right? That would be the nirvana scenario. I guess nothing is ever zero. And so, but I'd be pretty low on that. We don't see, even if Putin were replaced, his follow-on leader likely leading to that kind of resolution, where you'd see sanctions drop and normal trade flows resume. So the second scenario then becomes, unfortunately, a kind of a direct NATO on Russia conflict, if not with China. And the risks are higher than they've ever been, I think, for a long time, since perhaps the Berlin crisis. And I would put them at about 20%, where this eventually escalates into a NATO-Russia war. Hard to speculate after that how long this diversion in trade, energy trade, would last, because wars get to be very messy and so forth. The scenario I think we're really likely dealing with is what I call Cold War II, where maybe we have an armistice, sort of, but it's the Cold War sort of that we see in Korea or Kashmir or Cyprus, where there's an armistice, they stop shooting at each other, but there's no real peace, and there's no real resumption in prior trade flows and so forth. Perhaps there's exceptions for things like food on humanitarian grounds, but to be honest, Robert, I welcome your thoughts, but I don't see a return to status quo ante in terms of trade flows, oil and gas, between the EU and Europe for a long time. So the EU is going to have to be importing more LNG and oil from the United States. Hopefully, we keep our export policies open. That's a concern I have, especially as oil prices go up. I'm afraid that we may, in the United States, decide to restrict our exports in a futile attempt to keep prices lower for here. So I think there are concerns there, but I think Europe has got to learn to live without Russian energy for a long time, and it's not coming back anytime soon. Thank you for that question. Hi, James.
Can you hear me, Bob?
I can, yeah.
Well, I don't have a question. I have an apology. I got caught up in the time change confusion with my computer and the session, and I apologize to the audience as well for not being able to give you the introduction that you so richly deserve. IAEE was very proud to award the book award to your research this year, and so glad that you were able to join us for the webinar today.
Thank you.
I do see some questions in the chat. Let me maybe pose a few of those now, if we still have time to do that.
Sure.
How is coal relevant, and what's your outlook on coal? And if you've already answered this, I apologize coming in late.
I haven't. You know, one thing I learned, especially working for President Bush, is there's only two possible answers to a question. I know the answer, or I have an answer, and I'll give it to you. And I don't know, and I'll try to find out. And on coal, I don't know. I'm sorry, I'm going to have to give you the second answer. I'm not a coal analyst. I'm afraid I don't have an informed view on coal. Sorry about that.
Well, that's the right answer, if that is your answer, for sure. Also, in your presentation, you focused on trends mainly in the OECD countries. And in fact, the bulk of demand growth is coming from non-OECD countries. So the question is, in these countries, oil demand growth will continue due to the population and GDP, China, for example. And so some experts are considering that the Chinese demand may peak sooner rather than later. What's your anticipation in the Chinese story?
Yeah, I know Sinopec, I think, has said by 2030, and others see sooner. We see stronger and longer sort of demand in oil and transportation being stronger and longer in China. China has ceased its EV purchase subsidies for the end of last year. We're going to have to, very interesting to see how the sales turn out. And there have been reports that the early years so far, actually around the world, EV sales are off. We're going to have to see how quickly they will grow if the government is not willing to subsidize them. And it was those purchase subsidies that really drove the uptake of EVs and so forth. And so we see, decent demand growth in transportation in China. In the transportation side, of course, industrial use and so forth. We're going to be updating our long-term outlook later this year, but I wouldn't put a date on 2030 or even 2035 on the end of demand growth in China. To your point, though, OECD, I think most folks, again, we don't see a lot of data, a lot of specifics, unfortunately, from these peak demand forecasts, but I believe most of it arises from the OECD, where they see, as the EIA is predicting in the United States, gasoline demand has already plateaued, and many believe this, and will decline in the coming years. So, and then similarly in OECD, Europe, and other places. And I'm not convinced. I'm not convinced, and I see no evidence for it yet. We saw big efficiency gains in new cars purchased when oil prices quintupled over 5 years. Yes, but oil prices have been in a bust phase. Fuel efficiency is not improving. And there are headwinds to EV policies. Look at Manchin's conditions on EV sales in the United States. Not clear there's a single EV that'll qualify under all of Senator Manchin's conditions. So I think we have to wait and see, but I think the consensus has jumped a little too early into the sense that oil demand is decelerating or that it'll peak in China anytime soon. As long as we have solid GDP growth and per capita income rises, and people still want, raspberries in February and plastic bags and to go see their aunt, they're going to need transportation, and transportation is going to be provided overwhelmingly by fossil fuels.
I'm not going to suggest that that was a Freudian slip or President mentioned, but never mind.
I thought of that.
I have another regional question here in the chat, and that has to do with the GCC. Given that major investment appears to be coming from the Gulf Cooperation Council, doesn't that imply that that region will become even more important in the future from both an economic and geopolitical basis, no matter how much the demand increases?
Absolutely. Great question. You're absolutely right. Notwithstanding some real stars like Guyana, some places, the action for upstream investment is mainly in the Gulf, the GCC area. And even, I believe, the agency forecasts, IAEE and EA and others, I think all of them see, well, usually they do OPEC, but it would be Middle East OPEC share of global oil production rising. And, again, in the happy scenario where demand decelerates and we have spare capacity at 5% later this decade, again, a nirvana scenario, all that spare capacity is pretty much going to be in the GCC. And so both from a share of production and a dominance of spare production capacity, the role of the GCC would be even more important in coming years. I think that's not one thing on which all of us can agree.
Mm-hmm. Mm-hmm. Sounds right. There's a bit of a technical question. I don't know if you will have an answer for this or not, but this is coming from a trader who has asked, what are your considerations on buying, including specifics? Because I'm buying as we're speaking. Lots of laugh.
Well, I can never, of course, give trading advice. I'm not a registered trading advisor. I would never presume to do that, et cetera, and so forth. And but whoever he or she is, email me afterwards. Perhaps we can have a conversation. But look, I'm an extremely cautious investor, and until 2021. I mean, cash, gold, drinking water, those are my diversified portfolio. I very cautious investor. I have never been as professionally convinced of anything, as I am that starting in late 2021, we entered the foothills of a multi-year boom cycle. I know we are structurally short oil this decade. I'm very sure that the consensus has embraced wishful thinking instead of sound analysis about the rate of demand growth for oil and transportation this decade, okay? And the way to play that is to buy and hold undervalued oil equities. If you want to trade the price, that's a little choppier. So that's my thinking since late 2021. However, as you know, if you're trading, the lady or fellow who's asked the question, recessions, contagion, I mean, you have to scale into this position. So I have not loaded the boat, so to say. I am choosing my levels, and I'm looking to, average in at as low a price as I can. And with recession risk rising, that has obvious implications for how cautious and defensive I'm being near term. But my friend Arjun Murthy does a wonderful Substack on this, and he talks about the equity markets, and we very much are aligned in our views. Me more on the oil, he's on the equities, but I would follow him. I think his thoughts are also really important. But you may get lower levels because prices of oil equities may go down with the oil price and with contagion risk, but you want to buy with both hands when you think we're at the bottom, and I am.
The last question I see in the chat really follows up on that, and maybe you've already addressed this in the presentation, but let me just ask, what would you cite as the petroleum industry's kind of most similar period of underinvestment coming, historically? What could we look to as an example?
That's a great question. That's where I'd answer, I don't know, but I'd love to find out. I'd have to, I would guess that, well, it's, I'm not sure. I think perhaps the late 1990s gets a little bit close after we had oil prices fall to low levels. So the late 1990s into the early 2000s, I think you saw, but I'm not sure that, and I'd like to look at the data, I'm not sure that gets to what we've seen recently in recent years and what we're likely to see. In other words, when we came out of that drawdown in investment in the late 90s, we had $10 barrel oil. Remember the Asian financial crisis, OPEC cut too early, goes to Jakarta, all that. And then after 2003 came out of it, you saw supply respond to some degree. Actually, no, not OPEC was flat, but investment increased, certainly after oil prices had recovered. But so I think it's probably late 1990s, but that's a good question. I have to think about it a little more.
Yeah, good. One more question, and maybe this will be the final one, unless there were some other questions coming up. But that is, could you elaborate on your thoughts about the future trend in shale worldwide? And is that optimistic or pessimistic view on shale?
Excuse me, near-term pessimistic, even in the US, let alone abroad and so forth. The above ground risks that shale deposits abroad face are still there. All right, there's still public opposition to the footprint that's required. There's a preference, like in China, for other resources, coal bed methane and conventional oil production. And so Algeria hasn't really been tapped at all. So I still think there's a lot of headwinds confronting shale development, not resources, outside the US. And even more so, of course, with this whole decarbonization, conventional wisdom and sense that we must prioritize decarbonization. So I think right now it's pretty pessimistic. However, we got to get through this contagion and the banks and so forth. When the world resumes a normal growth trajectory, and when we have put behind us the major bearish macro risks, which may not be for a while and maybe but are much more suffering near term, I think capital is going to go back to shale big time, and maybe even abroad. I think we're going to have a shock, when this next boom starts, and we realize that it was unwise to reduce investment so much, and that decarbonization of transportation will take longer. I think we need to touch that hot stove firmly and burn ourselves to learn the lesson that it's unwise. It's understandable from just an investment cycle standpoint, what happens in a bust, but to pile on and to try as a policy matter to prevent investment or retard the return of investment to the fuel source that provides almost all of our transportation is unwise. And that transition aspirations, as my friend Mark said, they are still there and they need to be there and worked on, but they have to align with realities. And so I think what's going to happen this decade is not just a boom cycle, but a shock as we realize we were wrong to hobble investment. And when that happens, we're going to go back to where you can get the fastest return on your oil, and that is shale. So I'm optimistic. Ultimately, I think things have to get worse before they get better. But I think human beings learn. We're going to learn. We're going to make mistakes. We're going to learn. We're going to touch the hot stove, and then we're going to remedy the mistakes and try to make them again. So I would be optimistic on shale deposits, sort of maybe later this decade. Investment there. We have lessons to learn first, though.
Well, on those solemn words, I think we've come close to the end of the hour. I don't see any further questions in the chat box. But before we close, I want to again, on behalf of IAEE, thank you, Bob, for the presentation today, and to congratulate you again on the accomplishment. You've put a book on the shelf that many oil economists are going to be reading for many years. So thank you, and thanks all of you in the audience also for participating today.
James, thank you very much for your leadership, for the IAEE, for hosting this event, and to my friends and colleagues who joined today. Thank you very much. Really appreciate it.
IAEE would like to thank both James Smith and Robert McNally for an outstanding webinar. This webinar will be available on IAEE's website for future downloads. If you're not a member of IAEE, we encourage you to join by visiting iaee.org. We thank you for attending, and I officially close this webinar.